And Adem, it's been a long time, man. Even though you're a star now. How are you?
How you doing, Dale?
What's top of mind, bro?
Uh, well,
You sound a little low.
sorry.
Everything okay?
Yeah, sorry. Got a little cold
Oh,
or
yeah.
something. It's
Yeah.
snowing
COVID?
down here like crazy.
Where are you? Where's it snowing?
I'm up in Flagstaff right now,
Oh,
up
okay.
in
Because I know.
Arizona. Yeah, there's a
Okay.
big winter storm.
I know Flag. Yeah. Okay. I
Yeah.
thought you lived there all year long, or you were in the valley, or you're going to school there.
No, I was just up here for the winter to snowboard.
Oh, okay. All right. So, with your upper respiratory infection going into the Fed, let's start there. What do you think they're going to do? Um,
Well,
and and you know, what's your outlook on some of the markets, and what are your radical ideas that you're considering?
yeah. So the Fed today, yeah, it's hard to. I mean, I feel like they're kind of stuck at this point. So they've already expanded their balance sheet, some like 300 billion, and the data
Yeah,
hasn't even been renewed. So I'm assuming it's going to be even higher. And if they tighten 0.25, which they'll probably do maybe for confidence, but they're
right.
effectively stepping on the gas and the brake at the same time, right? I mean,
Okay.
they've already erased like 6 months worth of QE. I'm sorry, QT
Yeah,
within a week, and it doesn't look like that's going to stop anytime soon. And each rate hike is just going to make it worse because a lot of these banks are sitting on some pretty big losses, and they're also losing deposits. I was actually looking at that. Yeah, so U.S. commercial
why
bank
did it take so
liabilities.
long for people to know that institutions that bought paper at Civil War lows and rates had losses? I
No,
mean,
I
what was the really the catalyst for it all coming home? I mean, it's been that way for you know a year.
yeah. Well, that's usually the
So
thing
why
is that,
now? Any idea why now?
well, I think so. A big reason for SVB. Well, first let's go back to the Fed. The Fed flooded the system with deposits, right? I mean,
Yeah,
they forced deposits onto these banks, and as we know, deposits are a liability. You need to do something with that cash, and they were forced into these assets, and bonds, mortgage-backed securities, agency, non-GSE debt, etc. And when they were buying at the top, also when funding for SVB, a big problem for them was they were so tech startups don't make money, right? We all know that.
yeah,
Most of them don't. And
yeah.
when you depend on new deposits, meaning a bank makes you a loan and then the company draws down their money to pay payroll, expenses, etc. But VC funding has dried up dramatically over the last year. So companies or VCs, when they stop making new loans or new investment activity for these companies, they have to start drawing down their deposits further, like their cash burn rate. So money was fleeing SVB for the last year. And we all know that the Fed flagged it. I mean, SVB was, they had problems going into the year 2023. And I
Okay.
think that there was just it just takes one,
Yeah, it's like
obviously,
this
like Peter
last
Thiel.
straw, the last straw to break the camel's back,
Yeah, it's
or is
like
that, or is that
yeah,
last
right.
snowflake to start the
Yep.
avalanche?
Exactly. And I think
Yeah.
it's important with these markets because then they're all like driven by power laws. So yeah, they all have the same initial conditions, just like an earthquake or except anything. They always start out the same. But is it going to be this time worse? Like the magnitude ripple through even worse, like that extra snowflake tips the avalanche. And you don't know when it will be. I mean, it's impossible to ever say, but I think we saw, yeah, SVB, tipped over. Then we saw SBNY, New York Signature Bank. Then now First Republic Bank. And even though SBNY and First Republic aren't technically banks by the Fed standards, but I mean, obviously they're large. I think one's the 30th large, and the other one's like the 100th largest bank in the U.S. SBNY was this third largest failure too, and SVB was the second. Then we had Credit Suisse, and they had to change laws in Switzerland to basically ram that deal through without shareholders voting even on it, and they wiped out some $17 billion in COCOs, which for anyone not familiar, those are AT1 bonds. They were basically supposed to be converted into equity. They're perpetuals. They're pretty big in Europe and Asia. And we saw Asian COCOs had a pretty big drop earlier this week. So yeah, I just think the Fed's problem, and each rate hike is going to make it worse. Because it was, if you hold these things to maturity, you don't have to realize the losses, because a lot of these things are based off their future cash flow. But if the banks now, this is the most troubling thing, because if banks are bleeding deposits, which they have been for months now, you really only have two choices. You either raise your deposit rates, your savings rates to attract capital, but it'll crush your margins. So that's going to be happening at a time where loan growth is slowing. And a chart I like to look at is, so this is the net percentage of domestic.
Okay, why you're not sharing your screen? Why don't you?
Oh, it's not.
I'm going to stop sharing because I didn't know you brought anything. So go ahead.
There we go.
And then I'm getting the question from one of our attendees after this. How do you think the LIBOR to SOFR transition will affect the shadow banking system? And Harold Malgrim was talking about the shadow banking system is like 3 times as big as it was in 2008. And he thought there'd be problems from there too, not just mid-sized banks. I don't know if the Fed could do anything about the shadow banking system, could they?
It'd be hard to. So the shadow banks mainly just use, like the federal agencies, the GSEs and other shadow banks, like the Federal Home Loan, the funding, I think, lender. They basically just use the banks to net profit, because they can't borrow reserves from the Fed. They can't collect interest on excess reserves at the shadow banks. So with these banks just hoarding reserves, which we've seen, or the big banks at least, you see these other companies, they'll come in, they'll lend to etc. other banks on the interbank. They'll just stash it in their reserves, collect the interest on excess reserves, which is like 4.75% right now. So banks have they're just getting free money, basically just hoarding these reserves, which I think is kind of what the Fed wants in a way, because they want to prevent reserves from flooding the system. Because every hyperinflationary incident we've ever seen in history, Weimar Republic, for example, in Germany, early 1920s, bank reserves were leaving just as fast as loan demand, right? So like all that money was being pumped out the door. Whereas in nowadays, like Japan and America, Europe, you just have all these reserves in the system just sitting there. Like they're just not being lent out. And it makes sense because the Fed is trying to keep the rates up, but it's also creating arbitrage for all these other funding like shadow banks. But yeah, sorry, back to,
go ahead.
So banks are now tightening credit, like across the board.
Let me ask before you go, do you think that one of the solutions they may end up having to go to is bail-ins?
Oh yeah. I mean, I think it's going to be bail-ins. You're going to see more concentration of banks. The top 5% of banks control some like 50-60% of total assets. So I think we're going to keep seeing like capital flight out of these regionals and community banks into the bigger banks, which is going to be a problem because a lot of people use community banks and regional banks.
That's gonna slow the because they made most of their loans to local businesses. But you really believe there will be bail-ins, and the banks, instead, it's the opposite of what the Fed is saying now. They're implying they're backstopping everything. So why would there be bail-ins if that's true?
So even if the Fed backstops everything, it's just temporary right now, right? Like the BTFP, the Bank Term Funding Program, and discount window, they're essentially, it's just a collateral swap. It's saying, hey, instead of you guys going on the market and selling. And I was looking at like Bank of America's, and I don't know how I can get rid of this, close this thing. Oh, well.
So I'm getting the vibe from you that as sanguine as so many people are about this, you're very concerned. And it's not that we have solved this liquidity problem, like some people are saying, and now we have a credit problem. You still think we have a big liquidity problem that it hasn't been solved. It hasn't been solved. So that we're going to have a financial crisis. We're in the middle. It's already started, and the Fed is just like putting their finger in the dike and won't be able to hold back the water.
Yeah, I mean, yeah. So I think the Fed is just trying to buy time here, but they're also buying time for the economy to recover and more loan generation or asset price approval. Because but that's kind of a problem.
Now they want it to recover. They wanted it to slow down.
Well, yeah, I agree. That's like like the Fed is like the wrecking ball, right? Like every time they flood the market with deposits, banks go out and you have to buy assets at the highest price, and like things like QE. All QE was meant to change was the balance, portfolio balance channel. And like Bernanke even came out and said, he's like, we're basically going to make long dated maturities, short dated maturities. And it was meant to force banks who, let's say they sell a mortgage-backed security or a treasury debt to the government. The idea was they would have to rebalance their portfolios to buy similar like bonds. So they go out and buy high yielding corporate credit bonds, and then that would lower the spreads, and then corporations could borrow cheaply. But it didn't really work out that way. All it did was create a huge asset bubble. And I mean, yes, certain companies were able to get funded, but it didn't trickle into the economy like they expected. So I think they're fighting the last war with a lot of these tools. And I think that's the problem today, because if they don't have, they're using the BTFP, and these are all 1 year, short dated loan, like same with the swap lines they're doing with Europe. They have to be paid back, right? They have to swap it back eventually. So I think the Fed is trying to buy time. They can get the liquidity under control. And then within a year, these banks won't have needed as much, or depositors will come back, or whatever growth will pick up, whatever they want. And then these banks can just swap back, get their assets back, instead of being forced to dump on the market. Because like this chart shows, I mean, look
so
at
they bought us a year.
Yeah, but I don't even think it's going to become a year, because we already know these things. So banks have already been tightening credit for the last 3 quarters. So this chart basically just shows the net percentage of banks that are tightening, and it's across the board. I mean, large to small business loans, credit card loans, auto loans, right? They're already tightening credit significantly. And you can always see before each recession, or once the recession starts picking up, before recession hits, credit tightens. And it's kind of reflexive. It like feeds on itself, because banks are the main outlets for credit, right? I mean, that's where the liquidity comes from in the real economy. It's not the Fed. And we've seen that the Fed technically doesn't print anything. They can just pump banks full of reserves. And then in theory, the banks go and lend the money. And that's how it creates deposits and generates growth and keeps liquidity flowing. But now if they're tightening at the same time, and this is the chart I was showing earlier. So if they're tightening while bank deposits are already leaving, it's hard for me to see banks not, and this was before SVB blew up, banks were tightening dramatically. So I was just reading a thing that auto loan origination, like credit extended, basically like turnaways hit like 2009 highs. So they're already starting to turn away. Well, that takes out the marginal buyer, right? If you can't get a loan, and we're in a credit-driven world economy, if you take credit out or even slow the growth of credit, it's pretty deflationary, and it's pretty bad for growth. So banks are stuck between you have 2 choices, really, honestly. They can either raise saving deposits to attract
to attract deposits,
savings accounts to attract deposits, but it will kill net interest margins, right? I mean, if they're not extending loans and the long end of the curve is going down, and then they're trying to raise deposits.
That's like their only profit center has been the spread.
Exactly.
For a long time, right?
Exactly. And then and the other solution.
So the Fed took the spread away from them.
Yeah, more or less. Or the other situation, they keep deposit rates low and they keep bleeding deposits. Yeah. And so that's what I'm saying. The Fed is at this point just has their gas and their foot on the brake. Each rate hike is going to make it worse. But I think even at this point, banks are going to be more concerned about their balance sheets either way. If they raise deposit rates, that's going to raise the cost of capital for banks, and it's going to hurt their profit margins. So you're going to be putting them in a position where their net interest margins will be declining, or they're losing deposits at a time where their bank balance sheets are already suffering.
So it sounds pretty dire, Adem. What are you telling your subscribers to do?
Well, right now I'm just waiting for the smoke to clear because there's a ton of noise. But I know you and I talked a few months ago. Last time I said I was long bonds, and that worked out wonderfully so far. Just the 10-year, but I'm still holding it. I think the Fed is going to be forced to cut sooner than later. Maybe not this time, just to hold up confidence. But I fail to see how they can keep tightening while, and it's not unprecedented. I mean, Bernanke back in 2008, they held the 2-year. They held the Fed funds rate overnight rate to 2. They were fixated on keeping it at 2% because they were worried it would stroke inflation any higher, and so they were over tightening until finally they were oh yeah, let's just knock it all the way down to 0, and then they started doing QE.
So all right, so you like bonds? Is that it? Bonds and cash in this environment?
Yeah, just till the smoke clears. I mean, I'm looking at some.
What if the smoke smoke is just going to get, according to you, the fire is just getting started. So how's the smoke ever going to clear?
Well, I'm assuming once the Fed cuts, it'll try to re-grease the wheels, and that's kind of another thing we're saying. We're already seeing the yield curve. The yield curve is already starting to uninvert, and I was just writing about this the other day. That's the real problem, because there's only 2 ways for the yield curve to uninvert or steepen. One, growth and inflation pick up, which causes a pricing of long-term, and that's not what's happening. That actually hasn't happened in the last 40 years. So every time the yield curve starts steepening, it's because the Fed cuts the short-term rate, which, brings the inversion rate down. And that's what we've seen in every single time. And I think now with the yield curve steepening, they're effectively tightening into it. I think, not to mention, you have student debt coming back on. The consumer household debt's at 17 trillion. Credit card defaults, 90-day delinquencies on credit cards for the age groups of 20 to 49. They're at 2009 highs right now. It's gone straight up over the last few months. Wow. And auto loan delinquencies 90-day for the same age group, 20 to 49 years old, is back to pre-pandemic highs. So, and that's just within the last couple months. And that's from the New York Fed's data. So it's not so we're already seeing them. Then you have student loans coming online. That's I was seeing average payments around 300, 350. And I don't like using the average, but let's just use it for this. That's a big tax on people. We saw the SNAP program end recently last month, which was
food.
Yeah, the food stamps, which was for some 30 million people, giving them about $200 worth of food. So there's all these stimulus programs or things that were giving people that extra money, and now all of a sudden it's been taken away at a time where the excess savings. I mean, it's hard to know how much excess savings it really is.
We have such a labor shortage. Maybe those people might think about going back to work in the middle of a deep recession.
So while I agree, and I do think and I think that's why Fed can't get the labor market under control, because that's a social issue, right? And it's not an economic one. And we've seen it. I mean, if it was an economic one with wage growth this high and such a shortage, 2 open jobs or 1.7 for every unemployed person, you would have seen new workers flood into the market to soak up those higher wages. But we haven't seen that. And I think that's a problem that the Fed is kind of sitting there perplexed, because they can't.
Isn't
I
it
mean,
a
if it's,
demographic issue?
yeah,
You're saying
demographics.
it's
So
a
yeah.
social,
Oh well,
or
yeah.
is,
Sorry, I meant yeah, social demographics. Yeah,
oh,
that's what I
okay.
mean. Yeah, sorry.
Okay.
But so they don't really have a choice. But at the same time, a tight labor force doesn't necessarily mean growth. So Europe, Canada, Australia, Japan all have record low unemployment rates, and they couldn't get inflation or growth going. I mean, Japan has like a
Okay.
2% unemployment rate or something since
Yeah.
2016, and they just can't. And
Great
besides
point.
energy prices, so the real issue now is if real wages can sustain consumption. And in
Yeah.
my opinion, they can't. Obviously, that's why we see credit card debt, household debt ballooning.
Yeah.
Household debt just hit a 17 trillion record high, because if you take away the credit, you're taking away that excess consumption. And that's why when deleveraging cycles happen, there's just no demand for loan growth, because you have to repair your balance sheet. And if real wages, which have been effectively flat for 40 years, I mean, we saw some growth in 2022, but at the same time, with inflation so much higher, it's technically been negative. I think it's just turned positive recently, but it's like marginal. So I have some friends who think that the soft landing is going to happen because real wages are going to carry consumers, but I don't think it's nearly enough to sustain the kind of demand or consumption that's needed. And
Should
I mean,
we be looking to short the stock market? We've held that October low for a long time here. We're looking about 6 months, new lows coming in the market, or are we going to have
yeah,
a melt up because monetary conditions will loosen?
yeah. I mean, it's always, these things could be so fickle, right? Like bad news is
Yeah.
good news is bad news.
Yeah.
But I think as long as they're trying to tighten and the banking stuff is going on, there's more pressure to the downside. But there's also a significant amount of money now sloshing around. And there's also a lot less publicly traded companies over the last 20 years. Yeah, I think US publicly traded companies are down half. It used to be like 8,000, now it's around like 4,200. Not to mention, we've seen huge share buybacks over the last decade plus. So that already just took away a lot of the supply. So even without the Fed pouring gas on the fire on the demand side,
Yeah.
you would have seen higher equity prices anyway, just from less supply. And so it's hard to say.
Let me
I think it's
ask
gonna
you
be
this
choppy.
about, is there going to be, I want to know, are you as complacent as everyone about, first of all, everyone thinks the market's a range, which makes me think it's not going to stay in a range because everyone's bought it. That's the narrative, 36, 3,800. I've asked other people, do you think there's going to be a problem with the debt ceiling this go around that could lead to a downgrade and even a self-inflicted wound?
I wouldn't put it past politicians to do something idiotic, but I mean, yeah, I do think either way with the debt ceiling, because it's kind of a weird situation, because if okay, making matters even worse now, if banks are
Yeah. All right.
worried about deposits at this point, imagine when June
Yeah.
comes and they raise the debt ceiling $600 billion, forcing
Yeah.
primary banks to drain their reserves because they don't give them a choice, right? The idea is you they sell you the bonds, $500-600 billion batch, and then the primary banks slowly
So
sell
this
them
is
to
going to
customers.
exacerbate the financial crisis we're in. Not
Yeah, it
necessarily
definitely could.
not because they don't pass a debt ceiling, but because they do raise the debt ceiling.
Yeah, I mean, it could. I mean, that's what we saw in 2019, right?
Okay.
There was already a dollar shortage. Bank reserves were down. Granted, they're higher today than they were back then, but they they forced all those reserves out of the banks to buy these bonds, and then
Yeah.
corporations came and they were like, "Hey, we're going to do early tax filing season," and banks were like, "Holy hell, we don't have enough cash on hand." So they had to open the repo market, right? They were like all stuck with bonds, and they were like, but we don't have cash. And the Fed lost control of the overnight rate basically because banks were scrambling, trying to get whatever cash they could from each other. So now today it's like kind of the opposite problem. But now with financial conditions tightening, who knows what a $500 billion, or if that's even the minimum they'll do. And then obviously
Yeah.
there's the other risk if they don't raise the debt ceiling.
Yeah.
yeah, I mean, Jesus, that would be very deflationary, and just because of the plunge in spending in America,
Yeah.
so which is basically carrying global growth at this point.
And
Nowhere else is growing.
and rates would go up harder to for debt service, and maybe a
Yeah,
downgrade even if we don't. But it looks like
yeah.
we're having trouble doing it, like last time when Moody's did it. Well, I'll tell you what, Adam, you are a bank plumber. All right, you know the plumbing of the banking system quite well. So best way for people that don't hear this kind of stuff and maybe need to hear this kind of outlook and insight from you is right there is for your website. This isn't your website, is it?
Oh no, no.
No.
Sorry.
Let's see. We don't want to just go
All
nuts
the way
about
back
that.
up.
And you could follow Adem on Twitter at Radical Adem, but he does a lot of very interesting writings. He's broken into the rotation on with Blake over there at what's the name? I have a mental block right now.
Oh,
Anyway,
the
this
Trader
is
Summit.
Trader Summit, and you're writing poems, people are saying. Oh, okay. All right. So
No.
the yield curve is steepening and no one's talking about it. I noticed it, but no one's talking about it. So great to catch up
Yeah,
with you, Adem.
yeah. Thanks, Dale. And
What do
anyone
you think?
interested?
You think that we should just like, find a bunker and be prepped and have a lot of cash? And would you buy crypto to get outside the banking system now?
Yeah, I mean, I have some crypto in like a wallet, just
Yeah,
that it just sits there.
yeah,
But I mean, that I've been buying for the last like few months when it was after the
okay,
FTX thing. But I mean, I'm
okay,
not selling it, so I mean, I don't think the
okay. So
dollar's
you
going
think it's a
anywhere.
good hedge for what we're doing, where we're heading,
Yeah, I mean,
or you wouldn't have put money into it?
yeah, I mean, just to diversify. But I mean, yeah,
Okay,
I think gold, and I mean, I like gold. I have some physical gold and stuff
yeah.
just in case of anything. But I mean,
Oh
granted,
yeah.
those are
What's your
I don't look.
address?
Granted, they're they're all speculative assets. Like I don't
Yeah,
believe they're money, because at the
yeah,
end of the day, you can't go pay your taxes, right? With these things, you got to convert it
yeah,
into those dollars. So,
yeah,
but I mean, hell, if I can get 2x for it, that's fine with
yeah.
me.
What about the CBDC? I'm having a hard time saying goodbye to you. When are we going to be using the central bank digital coin?
Oh God, I hope not. Imagine that, with the central bank being able to go into
Yeah.
anyone's bank account and adjust
Well,
their interest rate, or
well, they're
you
pushing
know,
for it, and I think
yeah,
nationalizing the banks, which is almost what they did, right, is one
yeah,
big step forward towards that, isn't it?
yeah. No, yeah. I mean, for anyone who's interested in monetary plumbing, there's a really, in like CBDCs and treasuries, all these shadow banking. There's a good book by
Yeah.
Joseph Wang,
Oh yeah.
called,
Yeah.
yes, Central Banking 101. And
Okay.
it's just a kind of a, little, not corny title, but it's very insightful, and about
I've
like
been
the plumbing.
joking. He likes Jay Powell, and he worked there, and I
Yeah,
was
he did work
joking,
there.
huh?
I said, yeah, he did work there.
Yeah, and I'm joking that he's going to be Powell's bodyguard today at the presser, that he has a black belt.
Yeah, I mean,
And anyway,
like-minded people,
yeah.
they all have the same
Anyway,
schooling, same education.
yeah. All right. Well, Adem, I hope you feel better. Uh,
Yeah,
take
great.
care of
Thanks, Dale.
yourself. Take care of
Yeah.
yourself. And uh, I don't know. I feel kind of bearish after talking to you for half an hour.
Well, who knows what will happen, but it'll be an interesting
Yeah,
time ahead.
yeah, very. All right. Thank you very much. Adem Tumerkan, Tumerkan, right?
Yeah, Tumerkan.
Tumerkan. All right, Adem. Thanks a lot, buddy.
All right, great. Thanks, sir.
Check out his stuff, everybody, and follow him on Twitter. That's a wrap. You could join the team in 12 minutes on the Morning Edge. And, good luck in the Fed today. We'll see everyone tomorrow. Remember, it's okay to do nothing. Okay, like Adem says, and wait for the dust to settle. Sometimes it's okay to be a spectator rather than a speculator. And above all, don't just count your pips, count your blessings. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.